Hi everyone, Bowen from Enhanced Asset Management. Just back to provide an update on some portfolio holdings that have reported so far in the reporting season. And I'll also just run through a few stocks that have a pretty high retail ownership base, particularly amongst our client base as well, just to provide some insight into the results and why the share prices are doing what they're doing. So at first, I just thought I'd run through just the volatility we're seeing so far this reporting season. So of the 28 companies that have reported in our universe so far, 13 of them have had their share price move either up or down 10% on the day. And that volatility has continued in the days after the result as well. The average move on the day for companies within our universe has been plus or minus 10.3%. Now, that's an extremely large figure for one-day moves. And it just goes to show this is one of the most volatile reporting seasons that we've seen. And, portfolios are bouncing around a lot at the moment. But at the end of the day, we're following the earnings growth and they're the companies that we're looking to invest in. So we'll start with Aussie Broadband. They actually haven't released their full-year results yet, half-year results yet. They'll release them on Monday. However, they have announced that they've signed a long-term strategic partnership with AGL and have also bought their telco business. Now, this is going to increase their broadband connections by around 350,000 with an additional 46,000 voice services. This makes ABB the third largest telco in the Australian market. This acquisition will provide $235 million of annual revenue and an expected $21 million of EBITDA before any synergies are realised between the businesses. Along with this, AGL then becomes a core distribution channel for Aussie Broadband. They provide transformational scale opportunity for the business and, they can market to AGL's massive client base. They have a huge client base that ABB can then use as a distribution network to really grow their presence, particularly in the NBN broadband connections. And we expect this to provide a pretty strong runway for growth for ABB. Onto the results. So the first one we saw was ResMed, and they announced their second quarter results showing 11% revenue growth with an expansion in the growth margin, and net income was up 15% with earnings per share up 16%. This is a business that continues to grow above market rates. They're highly cash flow positive. They're really building a strong war chest of cash now. Their net cash is now up to $750 million, which provides extremely high flexibility moving forward to grow inorganically through acquisition or invest heavily into R&D. Whatever they want to do, they have the flexibility to do it now to maintain that market position. ResMed continues to trade at a pretty sizable discount to our valuation. They've had a pretty soft 6 months so far. A lot of that's been impacted by currency conversion. A stronger Australian dollar against the US dollar has a negative impact on the ResMed share price, given they're listed in the US. But the business is continuing to fire, and as we said earlier, share prices follow earnings. Earnings are there. We expect to see the share price of this one trend up over time. Car Group reported a really strong result. They reported revenue up 14%, EBITDA was up 12%, and net profit after tax was up 16%. The guidance was retained, so they'll do 10% net profit growth this year, and they remain the dominant player in multiple global markets, not just here in Australia with carsales.com, but in the US with Trader Automotive, and then also their businesses in the Latin America and in Asia as well. They're the dominant players in all of their markets, and that perceived threat of AI disruption, it created an extremely attractive entry point for us to buy some of these high quality businesses, some that we'll speak about in a second as well. And off the back of these really strong results, we've increased our weighting to car. Moving on to net wealth, and another really strong result. Funds under administration grew 24%, revenue was up 25%, EBITDA was up 24%, and net profit after tax was up 20%. So they continue to grow their market share in net wealth. They're now the second fastest growing platform in the country, just behind Hub24, and they're really continuing to capture that market of the transition out of a lot of legacy platforms into these newer platforms, Hub and net wealth in particular. Again, its share price has been pretty heavily impacted over the past 6 months with the software sell-off, and we've seen the share price bounce pretty strongly off the back of these results, and we're pretty happy with our position in net wealth. REA is another one that we've seen share price weakness, and that's led to us taking a position here. Again, the results are really strong, and it just goes to show that this threat of AI disruption, especially in the short term, is certainly overblown. in the long term, we think that there'll probably be some companies that are a bit disrupted by it. But given REA's position, I just can't see it happening. They were able to increase their buy yield by between 12 and 14% this year, and that's effectively the price to list on REA.com. So volumes were slightly down, whether that's a factor of higher interest rates or a semi-volatile property price market. Volumes are down, but their buy yield just shows the pricing power that this business has. People have to sell their house where the buyers are, and the buyers are on realestate.com. People browse realestate.com. It's one of the most popular websites in Australia, and if you're going to sell probably your most expensive asset, you're going to do it to give yourself the best opportunity to interact with the most buyers you can, and that's always going to be through realestate.com. Management also announced a $200 million buyback, which just goes to show that management are really confident in the direction the business is heading. They think the stock's cheap. We agree, and we increased our weight following this result. Now we'll talk to Zip. We'll probably spend a bit more time on this one, just given the share price reaction that we saw yesterday. We'll just run through the headline numbers first. So we saw TTV, which is transaction value, up 34%. And in the US, this was 44%, which is the core growth engine for the Zip. Revenue was up 29%. Cash EBITDA was up 86% off the back of strong operating margin growth. And net profit after tax was up 120%. So you're probably looking at those numbers thinking, fantastic, great result. We were as well. The net bad debts is kind of where the market's focusing on here. So 1.73%, it was up from 1.56% this time last year. Management's guidance range is between 1.5 and 2%. It has been for a long time. So we're still on the lower side of that guidance range, but the steady uptick over the past sort of 2 quarters has really quite spooked the market on this one. So this is probably the slide that did a lot of the damage. So we saw the share price down around 30% yesterday, which we think is definitely overblown. So management have guided for second half bad debts in the US of between 1.75 and 2%. So you can really see over the past 2 quarters that bad debt level in the US has ticked up. Still within the guidance range, of course, but it's a pretty steady increase over the past 2 quarters. Now, why is that? Purely a function of Zip really trying to grow heavily in the US. And that's been their strategy for the last sort of 12 to 18 months, is growing that transaction value, growing those customers in the US. That's the big underpenetrated market. If you think about a business like Zip, they're a Pay in 4 product, recently launched a Pay in 8 product, which we'll get to in a minute. When they acquire a new customer, that's always going to be the riskiest time because they don't have any data on that customer. They don't know what their repayment history is like. They don't know whether they're going to be a reliable payer. So they set their credit limits and then they kind of adjust them based on how that customer is going repaying and how their history is looking. Obviously, when you acquire new customers, your bad debts are going to tick up. You're going to get some riskier customers that you've got perhaps a too high credit limit for, and then you're going to have to write off bad debts. But as this customer book matures, they've got that data. They know who their risky customers are. They can limit their credit, and we don't expect that bad debt level to continue rising too much more into the future. In fact, I think 1.84 might well be the peak. Hopefully, we've seen a 10% improvement in early stage delinquency, which we'll get on in a minute. So that's from the second quarter to the first quarter. It's getting better. But as I said before, on the Pay in 8 product, that now makes up 20% of the total transaction value you can see here. So this is a new product, and obviously it's got a much longer installment length, so up to 14 weeks. Obviously, you have a product with a longer repayment period, you've got more chance to default, more chance to miss payments and not be able to make those. So we think this is driving the bad debts here. It's also been able to drive TTV growth really strongly because it's performing really well and engaging well with consumers. But we think they're finding a balance now, and management have said that's it. They're not going any higher than 20% of TTV in the Pay in 8 product. So they'll probably look to scale that one back, and they've got the Pay in 2 product up and going now, which was only recently just launched, and it's only 0.1% of TTV at the moment. But obviously, that's a much smaller installment length, which means you expect to see much lower credit losses on those transactions. So if they can scale that part of the business up, we expect that bad debts will be coming down pretty steadily. And this is just what I was speaking about before, the decrease in the provision rates moving forward. So we saw that peak in the first quarter at 8.8% of receivables. That's now down at 7.7%, meaning that management are obviously a lot more comfortable with their receivable book, and they expect a lower level of bad debts moving forward to be written off. And we expect that to come down steadily as well as they focus more on that pay into product. So to summarize this one, we think that the sell-off is definitely overblown. The market's really focused on this bad debt narrative here, but we think we're probably at the peak, and I mean it's within the guidance range that management have guided for a long time. So we understand the steady increase in probably spooked a few investors, but this was their strategy all along. They've communicated that with the market. The market knows that 1.5 to 2% is a comfortable range. They're comfortably in that range at the moment, but we're seeing that investor sentiment turn pretty quickly on this one. The outlook was good. They upgraded their operating margin guidance. This was previously 16 to 19%. They're now higher than 18%, and they also upgraded their cash EBITDA margin forecast as well. So as we said, stock prices eventually follow earnings, and as long as these bad debts don't blow out and we see them start to get under control, even steady reduce over the next 2 quarters, we expect this one should return to the good books for investors, and we'll see the share price slowly tick up again over time. Now, we just thought we'd cover off a couple of companies that we don't own, but we know are probably pretty heavily owned amongst our client base, and those are CSL and CBA. So CSL reported a 4% decrease in revenue and a 7% decrease in net profit after tax. This was largely due to a reduction in CSL Behring, which is their core blood plasma business. Their revenue declined 7%, with also some margin compression in there as well. They maintained their guidance, however, and that was for 2.3% revenue growth and 4 to 7% net profit after tax growth. Look, they're going to need a good second half to hit that. They're 7% down in the first half, and they're guiding for 4 to 7 in the full year. So they're going to need a really strong second half. Not saying they can't do that, but I think there's definitely scope for downgrades here as well. CSL's PE multiple is reduced now from around 40 times to about 22 times. A lot cheaper than what it has been, but I think that's just a case of the growth coming out of this one. They're not doing the 10 to 20% EPS growth that they did over the past sort of 5 to 10 years. That's now come down, and we forecast an EPS growth rate of around 8% over the next 5 years. So on 22 times, it's probably still not super cheap. And again, if there's a downgrade in there as well, we could probably see the share price going lower. The multiples come out of it, so it's probably de-risked a little bit. But we're certainly not rushing out to buy it at these levels. And finally, we'll just discuss CBA as well. So the operating income was up 7% and cash NPAT was up 6%. Really strong results, reflected strong deposit and lending growth as well as sector-leading profitability. They're now trading on a forward PE of 27 times, with 5-year EPS growth expected to be 3% per annum. For comparison, with some portfolio holdings, Car and Aussie Broadband are both on 24 times, and we expect 12 and 20% EPS growth for these businesses. Zip down to a 17 times forward multiple, and we expect a 5-year EPS growth of around 25%. So, look, CBA, the results were really strong. The business is performing well, but just on that multiple, it's just extremely expensive. It's the most expensive bank in the world, and the growth just isn't there to support it. So, not saying this one's going to come crashing down or whatever, but we just think there's a lot better options out there in the market to be putting your money into.